lot of other investment. I
Okay.
like to
Just
compare this
wanted
to
to
the stock
record.
market.
Thanks.
Oh, thank you. No, you're totally fine. I like to compare real estate to the stock market because most people, when they think of investing, are just super familiar with the S&P 500. I think most people can agree that S&P 500 will generate over time about a 10% return. That is a great return, right? And in the example that I just mentioned, where we're assuming, hey, somebody's buying a $500,000 home, we'll say it's in, the Denver metro area, where typically, if you look at a 10-year annual average prior to COVID, it's around 6% annual appreciation. Some years we see more, some years we see less. We're going to say in all of our examples in the next couple of slides about 5% appreciation. And let's say we have $25,000 to invest. We can invest it in a primary home, with minimum down with 5% down payment, or put $25,000 in the stock market. With 10% return in the stock market, that's a great return, right? Year one, you're going to see $2,500 on your initial investment. Since you can leverage in real estate, you can use that $25,000 to get a $500,000 asset. If that property goes up half the return, so only 5% appreciation, okay, on the $500,000 home, year one gains in equity are $25,000. So that's a simple example of like how leverage can basically accelerate your wealth growth for you. Another big benefit of real estate is appreciation. So appreciation, typically real estate does outpace inflation. Normal times, not right now, and certainly not during COVID. Normal times, the Fed tries to keep inflation around 2%. Inflation is basically just the cost of, living going up over time, right? During COVID, we saw inflation go up into the double digits. We saw a real estate values go up into the double digits too. One year we saw 18% appreciation. It was crazy. Years like last year in Denver Metro, we saw, closer to 1% or more flat appreciation. So again, real estate is a long-term play. You have to look at, over the big picture, what it's doing over time, not, year to year, month to month. But appreciation is basically when a property's value increases over time. Rental rates also appreciate over time. So if in the same example, you bought the $500,000 home, this is assuming somebody bought it as a primary home. And then if you held it and say it goes up 5% every single year, which again for Denver is pretty conservative. Denver 10-year annual average of appreciation prior to COVID, so taking out the crazy high years, is a little bit higher than 6%. National average of appreciation in real estate is about 3.6%. So if you guys are located in Colorado, it's really high appreciating market here, which is awesome. Just take this with a grain of salt. If you're in a different market, you always want to look at that and zero in on like why you're investing in real estate. But taking that $500,000 home goes up 5% appreciation, the next year, that same home is now worth 525, so on and so forth. Over 10 years, that same property is worth 814,000. And that's just with owning the home. And again, inflation, like real estate doing its thing over time, going up in value. And I feel very strongly. Like I said, I invest in the stock market. I feel really strongly that real estate's only going to continue to go up in time. If you think otherwise, I would love to hear. Feel free to raise your hand if you think that real estate won't go up in value over time. I think unless if somebody's going to figure out 3D printing of houses real quick, that's just it's going to continue to go up in time. People will always need a place to live, right? People always need a roof over their heads, and that I feel super confident in. So just the appreciation gains, 314,000. Another benefit of real estate, principal pay down. So again, this is assuming somebody bought a primary home. They're making mortgage payments. With each mortgage payment. When you're comparing this to renting, you are paying a portion of your loan down with each payment. Okay. With renting, if you're on this call and you rent, you are paying a portion of your landlord's principal. So you're basically paying into their piggy bank every single month. If you own real estate and you have a mortgage and you have tenants, or if you house hack and you have roommates, they are paying down your principal for you. So it's great. So you owe less and less. Okay, you owe the bank less and less with each mortgage payment, and then you own more and more of the home. Okay, so this was assuming a 6.5% rate. And this was assuming 5% down payment. So principal pay down over 10 years would be 77,000. Okay. Um, Another benefit is cash flow. So again, in this example, somebody who's buying a primary home, we're in the red or in the negative year one, if you will, because that person is living in the home as their primary. Then they move out year two. Then they're starting to be in the green. This scenario was assuming they're doing a rent by the room, or sometimes otherwise known as co-living, for a long-term rental. I think I put in this scenario, I think I was assuming a three-bedroom house with $1,000 or $1,100 rent per room. And then I put, like I said, rent typically goes up over time. I put 4% rent growth every single year. That's super conservative, especially for Denver. But again, I want to really hit home on these numbers, even with conservative figures. And if you guys are investing in real estate, I encourage you to always use conservative figures, but it's great when you're pleasantly surprised and your property performs better. But assuming, the rent growth year over year over 10 years, the cash flow you receive is $48,589. Cash flow is on top of the mortgage. So that's basically your net after principal, interest, taxes, and insurance are paid. So that's looking at this over 10 years as a long-term rental. Truthfully, long-term rentals are harder to make happen in the current market. There's a lot of different strategies, which we're not going to go in detail on today, but like co-living and short-term rentals that generate a lot higher cash flow. But again, wanted to be conservative here. Um, I'm not a CPA. I'm just going to say that right now. I have my disclaimer written on the front that I forgot to mention, but I'm not a CPA and I'm not an attorney. You guys should consult yours for individual advice. But as an investor, I do know that if, basically your expenses on the property, such as anything related to operating, maintaining, managing the property itself, is an expense that offsets the income on the property. So if you have expenses and it completely wipes out the income on the property, you're not paying taxes on that income. And when we go back to like the very first, the quote we talked about, not just trading your time, kind of working smarter, not harder. I think it's not just about how much income you're generating, because we can all get raises and get paid more where you just get taxed more. You're subject to, it's on the slide, you're subject to FICA, you're subject to your marginal tax rate, you're subject to Social Security. Rental income is not subject to any of those things. And also, it can be tax free in a very legal way. Basically, the IRS tax code is written to incentivize homeowners, to incentivize people to own homes and also to provide housing because it takes that burden off the government. So, all these things are very legal, and you can look it up on the IRS website. As a newer investor, I was investing for cash flow because that's what helped me to leave my job in healthcare, and supplemented my income. And now it's nice to have that on the side to pay for daycare and pay for, whatever I want, and continue to funnel and like, fund my investments. But now as I would say more seasoned investor, I think of cash flow as protecting my appreciating asset. As you guys can see, appreciation is where the real gains are, in my opinion, in real estate, but it really just depends where you are in your journey, right? So I think that's something that if you're thinking about buying real estate, trying to identify that early on, like what are my main goals of investing here? Is it cash flow? Is it appreciation? It's okay if it's both. And then it's okay if it changes too. Finally, one of the big benefits of real estate, and why honestly a lot of people invest in real estate, are just for the tax benefits. There's so many things that you can go into. We could have a presentation on this alone. Again, I'm not a CPA, but some of my favorite tax benefits are the capital gains tax exclusion, otherwise known on the street as 2 out of 5 year rule. So the 2 out of 5 year rule basically states if you have lived in your primary home for the last 2 out of 5 years and you sell it within those 5 years, you can exclude up to $250,000 from capital gains taxes as a single filer, or up to $500,000 as a joint filer. Okay, so that's a huge advantage. There's not a lot of things that you can basically take advantage of and have gains on and just not have any taxes at all. So that's a huge one. We're going to talk a little bit more about the nomad approach in real estate investing. We've done the nomad approach personally. When we move to a new primary home, we always stay in our primary home at least 2 years in case if we wanted to sell. So that way we could take advantage of the 2 out of 5 year rule and not pay any taxes on the gains. Another huge advantage of real estate is you can draw on the equity tax free, right? Like, say you move into a house and it needs some love, it needs some new carpet, it needs some new paint, and you need some updating, and you add value to it. And then also the market's doing its thing and going up in value over time. And then you want to leverage that and invest further in real estate, or you want to take those funds and pay for your kids' tuition or pay off your student loans or whatever it is. You can do a cash out refinance on that property that has gone up in value, and you're not paying taxes on that because you're taking out a new loan on it, right? And you can just continue to basically tap into this like piggy bank of a house, which is pretty cool. Again, most other avenues of investments, stocks, even retirement accounts, you're paying taxes when you put it in or when it's dispersed. So real estate's pretty unique in this. And then finally, the ability, like I mentioned, to generate income tax free, or you can have paper losses. So again, there's legal kind of like loopholes, if you will, or code written in the IRS that allows you to take deductions to offset the income that you earn on your rental properties. One of them is depreciation. So even though your property is going up in value over time, the IRS assumes that your property is actually going down in value over time because they know there's things that you're going to have to replace over time, like the water heater, the roof. And so you can take that depreciation or like wear and tear on the property and use it as a paper loss to offset your income. An example, like quick back of the napkin example of that, IRS assumes depreciation on a property is across 27 and a half years, or the lifespan is 27 and a half years. So that would be on the same example of a $500,000 property over 27 and a half years, that would be about $18,000 in write-off a year. So say if your property is cash flowing $1,000 a month, you have this $18,000 depreciation per year. That just wiped out all of your income. So you're not paying taxes on the income. So I know $1,000 doesn't sound like a lot, like that's not life-changing, figures here. But at the same time, you're keeping that in your pocket. So if you did the math and you're like, how many hours would it take me to work at my job to keep $1,000 in my pocket? That starts to add up. And the thing is like I mentioned, everybody on this call, time is your most limited resource. You only have so much time. You can only work so many jobs. There's no cap on how much real estate you can own. So just something to start thinking about. Okay. And then finally, to wrap up tax benefits, like I mentioned, it's not about how much money you make. It's about how much money you keep, how hard it works for you, and how many generations you keep it for, right? So if anybody's read Rich Dad Poor Dad, I think that's probably one of the books that I read that got me to start thinking about, assets versus liabilities and just investing in real estate, and fired me up to start investing in real estate. If you haven't read it already, highly recommend checking that out. And that could be whether you're trying to invest in real estate or if you're just trying to buy a house. I think it's just a really good kind of like philosophy book. Okay, so financing strategies. Here's the fun part. And I appreciate you guys. I'm such a nerd about mortgages. I really like that you guys showed up to listen to me talk about this because I know it's not the most like fun or sexy topic. But excited to talk to you about it today. So financing strategies and products. So strategies, we're going to go over primary, house hack, and nomad. These are like your bread and butter. I think if you're getting started off and you don't have a ton of capital to work with, this is going to be your strategy. Probably it's a great strategy. I think a lot of people throw out like all these different high level strategies. It's back to the basics here, and there's nothing wrong with this. This is what we did to get started in our journey, and that's what Eric, the strategy that he used too. Another great strategy: second home or investment. Just buying properties as second home or investment. And then your products are going to be conventional and FHA. When people talk about like traditional loan products, those are the products that you're probably using when it comes to financing. Rehab loans, where you're renovating a property and you're wrapping the cost of renovations into a loan. DSCR, we're going to go over. That's a fun, shiny object right now, but also just a really great product too when it's appropriate. Bank statement loans, common for self employed borrowers or contract workers, asset depletion, or any asset based loan. That's really good for somebody who has a high net worth or has a lot. A lot of assets, but might not, have income that we can qualify income based on their assets. Home equity line of credit. A lot of people are taking out home equity line of credits right now where they have owned homes in COVID years and they're sitting on record high amounts of appreciation, but maybe they have a low interest rate and they don't want to change it. So they're tapping into their equity to leverage that into real estate or whatever they want to use it for. So that's a great option for that. It doesn't touch your primary home rate. Non-warrantable condos and hard money loans we're not going to go into today, but those are other great products too.
Before you leave the slide, I have a
Okay.
question.
Yeah.
What is Nomad and
Oh,
how's
great
that?
question. Okay, and sorry, I don't mean to brush over anything. I get super excited, obviously, when talking about this stuff. So if I say anything and you guys aren't sure, definitely stop me. Nomad investing is where you buy a primary, okay? You live in it and then you move out and you buy a new primary and you hold that first primary as an investment home. So that's a great strategy that, a lot of people do and that I did too to quickly stack your rental portfolio because as a primary home, you're going to have better interest rates, you're going to have lower down payment. So you can basically stretch your capital a lot further than if you went and bought just an outright investment property, which usually requires a lot more down payment.
And what is house hack?
House hack is where you are living in the property and then you're generating rental income on the property. And I have slides on these too, so I'm going to go through those in more detail also.
May may I ask about the depreciation thing that you had
Yeah.
mentioned? All
Yep.
right, so you had said that I believe you said that you can have $18,000 worth of depreciation in value on your rental property. Is that what you said?
If that's assuming like $500,000 home, 27 and a half year lifespan. So that's basically 3% of the home every single year if you take it across 27 years. So that would be about 18,000. Yeah.
So I'm depreciating the value. The 18,000. I'm depreciating that over that lifespan. Is that what you're
Over the
saying?
correct. Yeah. And not to get too
Oh,
nitty
okay, that
gritty
makes more
into
sense.
like, yeah, exactly. And not to get too nitty gritty into like IRS tax code, but I'm sure everybody's familiar with the Big Beautiful Bill. The Big Beautiful Bill, what it changed for a lot of real estate investors is now you can take that depreciation that was across 27 and a half years and you can accelerate it all to year one. So a lot of like high income earners are taking, so that's like, I mean, usually you can like
Like
accelerate.
each year?
Yeah. So you can take that $500,000 asset and accelerate it all to year one. So I've since last year when that Big Beautiful Bill came out, I had investors who like bought properties last year and they're already back this year to buy another one because they're trying, you can basically, if it's a short-term rental, use that depreciation on the $500,000 property and use it to offset your active income if it's a short-term rental because short-term rentals are considered active investing. So it's a really great strategy. And that's why I say some people invest in real estate purely for the tax benefits. Like they look at here's how much I make, here's how much real estate I need to go buy. Their CPAs advise them, here's how much more real estate I need to go buy to offset my tax liability. Yeah. Feel free to reach out to me after and I'll send you more information on that. We could just have a whole presentation. I could spend hours talking about that. But really great loophole. Um, So financing strategies and products. So if you're purchasing a primary home, um, a second home or investment, basically the check marks in green, conventional bank statement and asset based loans are all available to you. DSCR loans, those are only for investment loans. Okay. So DSCR loans, it stands for debt service coverage ratio. I'm going to go more in detail on that, but basically you're qualifying on the projected rental income of the property itself. Okay. So conventional financing. So again, this is more of your traditional financing, if you will. I get a lot of people who are researching real estate online, which is totally fine. That's how I got started too, but then reach out to me and they're like, "Hey, I want to do DSCR loans." And I'm like, "Great, let's dig into that more. Let's not just assume because you saw that online that that's the most suitable product." And actually, a lot of people who reach out about DSCR loans qualify for conventional. And so I will always try to see if that's an option, because conventional financing, if one is going to have a better interest rate, it's conventional financing over DSCR loans. DSCR loans come with a standard prepayment penalty, which means if you refinance or sell before that time, the penalty expires, like 2 or 3 years, you'll pay a fee. So that's why I always try to open up the term with the better option, and that's conventional financing. Again, it's not the fun, like sexy product that's written on every real estate website, but it's the one that's going to be in your best interest and makes sense if you can qualify this route. With conventional financing, if you're purchasing as a primary, as a first-time home buyer, or if your income is less than the 80% area median income in the area you're buying, you can put down as little as 3%, even if you're not a first-time home buyer. If you're a repeat home buyer and you're above that 80% area median income, then you have to put 5% down, which is still huge, right? Being able to put 5% down on you can do that up to, a $900,000 home. That's huge. That's crazy. So that's a great advantage there. Again, the ability to just stretch your capital as far as you want, whether you're buying it for your family or whether you're buying it as a future investment. This change, I highlighted some of the things here I just wanted to point out. Conventional multifamily, this guideline changed. It used to be even for a primary, you had to put 20 to 25% down. Now you only have to put 5% down. So if you're somebody who wants to house hack and receive rental income on the property you live in, if you want to buy a duplex, right? Because maybe you don't want roommates, you're not in that stage of life where you want housemates in your house, but you want some separation from tenants paying your property down or paying your mortgage. You can buy a duplex and you can put as little as 5% down if you're going to live in it. Okay. VA and USDA, if you qualify for those, you can put as little as 0% down. And then FHA loans, you can put as little as 3.5% down for single family homes and multifamily homes too. You can qualify rental income on an ADU or accessory dwelling unit. There are requirements for that I'm not going to go into detail to today. And then for the nomad strategy that we were talking about, when it comes to purchasing the second property, so say you own a primary home, you want to buy the next primary home and you want to hold this as a rental, people always ask, well, how can you keep qualifying for more real estate? At some point, doesn't the lender tell you no? If you get a long-term rental lease on your departing home, that basically offsets the mortgage from your debt to income ratio, so that way you can qualify for the new property. So that's how somebody can easily continue to just like stack and qualify for more properties, getting a long-term rental lease on that departing home. If you were to short-term rent that departing home, we typically need 2 years. A lender is going to need 2 years history to qualify rental income on that property. So a little bit more restricted there. If you want to purchase, say, you love the house you live in, or you have a family, or for whatever reason, you don't want to hustle and do the nomad approach where you're buying a new primary and moving and buying a new primary and moving, you can buy a second home if it's a property that you are also going to personally use. And you can still short-term rent it, or, rent it however you want. But it has to be something, if you're going to buy as a second home, it has to be something that you're also going to personally use. You can put down as little as 10%. So a lot of investors right now, I have a lot of folks, like I mentioned, who are trying to take advantage of the bonus depreciation to reduce the tax liability on their active income. And also, they live in Colorado, or they live in, I have a lot of people in California, unfortunately, investing here. Just kidding. And Texas too, like New York, like different states that they're buying in Colorado because they want a mountain home. And then also there's a huge advantage, right? Like guests are paying down their principal for them. They're generating rental income. That property is going to go up in value. And also it's providing a huge tax benefit for them as well. So they can put down as little as 10% on that property. Rates are about the same as investment loans. And then, to buy a second home, it has to be located a reasonable distance away from your primary. If you live right in Denver, you cannot buy a second home right in Denver. It has to, usually underwriters will say about 50 miles away, but it just has to make sense. Like, why would you be buying a second home in the market you're buying in? Rental income is not qualified for second homes, because the primary purpose is for personal use. And then you can't do you can't do a second home loan on a multifamily property like a duplex or a triplex or a quadplex. You can receive gift funds on a second home. So, say for example, if you and your family wanted to buy a property together, or you and a relative, you can receive those gift funds as a down payment. And then finally, an investment loan is basically where you're buying the property truly as an investment. Like that's the primary use. You can qualify projected long-term rental income with conventional financing. You can't receive any gift funds, and this is where the borrower, like you're not really intending to use the property yourself. Okay. One thing
That's
I want to go. Oh, one thing I'll finish, and then I'll answer your question. With purchasing the second property in the nomad approach, I forgot to mention the minimum amount of time that you have to stay in a property when you buy it as a primary is 1 year. Typically, you sign an occupancy affidavit at closing saying you intend to stay there for 12 months. Obviously, if circumstances change, that's fine. But if an underwriter sees that you're doing the, rinse and repeating of buying a new primary and staying there less than 12 months, they're gonna shut down. They're not going to approve your loan the next time you go get a new one. Like I said, when we do this, we try to stay in a house at least 2 years. That's enough time for us. We don't really want to move before then. And then we can take advantage of the capital gains tax exclusion if we want to, if we sell. What questions you had? Sorry.
what, how do you qualify for a USDA loan or an FHA loan?
Great question. So USDA loan is going to be based, it's you qualify if the property's in a USDA location. There's not a ton in Colorado, but there are some. Let me think, like Sterling, like northeast Denver, like east of Fort Collins. There's some out there. I mean, just like think of like agricultural areas, like rural areas. Yeah. So
Okay.
and you can look up on the USDA website and search for the property address and see if it's eligible. And then
Okay.
FHA loan, I mean, if like FHA loans, basically, if you qualify for conventional, you should qualify for FHA. FHA loans are good products if you want to put less down payment and and you're a repeat buyer to put 3.5% down. I'm going to go through pros and cons of FHA loans. But basically, if you have good credit, FHA loans are not usually the best route because mortgage insurance is higher and then it's going to stay on for the life of the loan. Typically, you're putting minimum down. Whereas conventional financing, mortgage insurance falls off typically after 20% equity or if you're putting 20% down, and then it's going to be lower if you have good credit. FHA loans are government backed loans that they provide to help, lower credit borrowers. So conventional financing, just to summarize pros and cons here. So typically the lowest rates and closing costs with conventional financing compared to some other products, no prepayment penalties, minimum down payment, like I mentioned, 3 to 5% down. Usually the guidelines are more flexible than government-backed loans, especially with nomad investing. If that's the strategy you want to take advantage of, mortgage insurance will fall off at 20 to 22% equity. You can qualify rental income if you're purchasing a multifamily property, such as a duplex, triplex, or quadplex, an accessory dwelling unit. And then also, if you're purchasing an investment, we can qualify rental income. Oh, and then one thing I didn't mention, minimum down on investment loans is 15% down. And then gift funds are allowed on primary and second home loans. Some of the cons, which is like, this is not a con really, but it's just like you need to meet traditional guidelines, right? Like I have people come to me and they don't have income or they don't claim income and then they want to get conventional financing. It's like, well, I can't make magic happen, but you need to meet guidelines. There's a limit of 10 conventional loans per person. Usually credit score requirements are a minimum of 620. We can only count long-term rental income. You can still short-term rent the property, but we can only count this for qualification purposes. You can't finance or purchase in an LLC, but you can always, if it's going to be an investment property in the future, you can quit claim deed or transfer the title into an LLC structure. It's not going to trigger a due on sale clause. It's a common question I get. As long as you as the borrower is at least 50% owner of the LLC or that new entity. I'm not an attorney again, consult yours for individual advice. And then for multifamily investment purchase, it's typically 25% down. If it's a primary, you can typically put down as little as 5%. Sometimes with DSCR loans, we can put down as little as 20% on multifamily. That kind of comes and goes.
I have a question before you.
Yep.
So the rinse and repeat strategy or the nomad approach that you are mentioning,
Uh-huh.
how do you know? How do you know what area? Like currently, I live in Denver, right? So
Hmm.
how would I know what area to do this rich and repeat strategy? I understand that like there's like for instance, apparently Georgia is a good space for real estate, but like how do I know in my own area how to do like is how do I know in my area whether I live in Oregon or Buffalo, New York or Virginia, like how do I know that this is the area to do the rinse and repeat strategy?
Yeah, that's a great question. So I think really like this is really good. You're getting the foundational knowledge, but I think like once you get down to like, okay, now how do I apply that to my situation? What should I move forward with for my goals? You really want to talk with a team. Like this is where I was saying like Eric and I can help, but for example, like on my initial call with clients, I'm asking like, what are your goals for real estate investing? So for you, if you're somebody who you're like, hey, I want cash flow, I also want appreciation, also I work full time, so I don't want a second job, like I want something that's pretty set it and forget it, then we're saying okay, we want to buy an A class property that's in a great area that's going to go up over time. Okay. You're gonna attract really good tenants because it's an A class property versus maybe like if it was a C class property, it might have, might be more like paycheck to paycheck or like lower credit, which is totally fine. But it's just something that you want to go in and purchase with that strategy in mind, right? And then we can either look at data if it's an area you don't know really well. So when I'm investing out of state, I'm looking at a number of different data sources on like what's the rent history, how many people own homes here, like how many new jobs are here, is it growing or is it going, is it depreciating over time? So these are all things that you want to look at. And then looking at like other things like what's the economic growth of the area, like what are the school districts, right? So local to Denver, like if you, for example, if you wanted like an A class property and you wanted to do a long-term rental or even a mid-term rental, like investing in a tech center, the Denver Tech Center might be a good idea because it's a great school district. It's in Cherry Creek School District. But if you want a short-term rent, it might be a different area. So I think that's where like get the foundational level of knowledge, reflect on like what you want out of a property, and then talk with a team who's done what you've done and they're experienced and they can advise you.
Yeah, that's something that I help with clients a lot of trying to navigate all the different strategies and different ways to invest in real estate and what's working in terms of just financially, and then what works for you and your lifestyle and what your goals are.
Um, Perfect. So creative strategy, so house hacking. So this is again just where you're receiving rental income on the property that you're living in. I like to call it a comfort versus profit spectrum. With most things in life, the more uncomfortable you're willing to get, the more profit, right? My first house, which I have an example if we have time at the end that I'm going to go through, we actually our first house was in Centennial, so near the tech center. We were living with my boyfriend at the time, husband now. We're living with three other people at one point, two dogs, and it was COVID. So like their boyfriends, girlfriends were always over. So it was a full house, but I was being paid to live in my house. So that's when I was in healthcare. That's what helped me leave my job and just continue to invest in more real estate because I was literally using my house as a supplemental income source. We're not in that stage in life anymore. We have kids now, like we don't do that. But so that's why I think like, thinking about you and your lifestyle and your goals and like what you want about this is super important. I knew I was not going to want to do that at one point in the future. And I was like, here's my time to do this now. And it was super fun. I lived with friends. It was awesome. And like I said, it helped me get to where I am today. So there's some sacrifice that comes with this too, right? But the house hacking strategy, if you don't want to do that, there's other ways to do it. You can rent by the room or do like a co-living strategy. That's what I just described that we did. You can do like a mother-in-law suite, a house that has, a separate entrance. We've done that as well. And, just like what Eric does, he short-term rents part of his property. You can do a multifamily, like a duplex or triplex where, somebody just has a completely separate unit, separate address, everything, and then you live in one of the sides and then rent out the others. Some of the pros of this, super low barrier to entry. If you're like, hey, this investing thing sounds great, I'm not quite sure if I want to buy an outright investment, it doesn't get easier than literally renting the property that you're living in. You can manage it super easily. You have eyes on the property. You keep close control of it. You're very familiar with it. And then it helps too when you move out and hold it as an investment. You're super familiar with it, right? You can shut it down whenever you want. When we at our last property, we short-term rented part of the property. When we had a baby, we just shut it down. When we had family and friends visit, we liked the flexibility to just like shut off and on Airbnb to allow people to stay there. And then with a primary home, you have a lower interest rate. This formatting kind of got messed up, but you have a lower interest rate than if you bought with an outright investment. So that just helps from a cash flow standpoint. And then you don't have to change your mortgage once you move out. The cons are if you are long-term renting and obviously have a housemate or somebody that's like a nightmare person, then they are where you live, right? But I think most like horror stories I've heard are like mistakes people make in real estate. A lot of it I think can be summarized by due diligence. Like if you just have to do your due diligence up front. I have a whole screening process I go through with tenants, and you know I could tell you if I've made mistakes. It's where I'm like, oh, I don't want the vacancy. I'm just going to break my own rule and go with this person or whatever it is. And so if you just hold your own boundaries, I think, and just screen really well, it'll save you a lot of headache down the line. So the most efficient strategy is if you were to combine house hacking with Nomad. Again, house hacking is where you're receiving rental income on the property you're living in. Nomad is where you're buying a primary home, holding it as a rental as you move out and buy the next primary home and continue to rinse and repeat. This is really efficient, like I mentioned, because you can put minimum down payment. And then also you're going to have the best interest rates with a primary home versus an investment or a second home loan. And then, you can repeat it. So it's really efficient. You can go as fast in the fast lane as you want, or you can go in the slow lane. Some people, I know some folks who literally move every single year. They want 5 properties. They will move. They've called me the past 3 years to buy a new home. For us, we moved every 2 years. And so you can quickly scale. It's the least expensive way to build a portfolio. And like I mentioned, you can qualify for a new home using the rental income on the departing home to offset your debt to income ratio. The biggest con, obviously, move frequently. I think there's a way that you can get creative to make it more convenient. For example, if you're going to hold the home as a co-living home or a furnished home or like a midterm rental or a short-term rental, furnish the property with the intention of I'm going to leave all the furniture in this house and then go do the same thing on the next one. That way you're not getting movers and moving all the stuff or having to move all the furniture with it. It's a lot more efficient if you buy with the intention. If you purchase the home with the intention, decorate it with the intention, all the things. So favorite strategies to start, nomad and house hacking, like I mentioned. We kind of went through all this a little bit. I think the strategy too is a really good cushion to market volatility. Obviously, if real estate's going up in value, like it's also going up in value while you're living in it, you're paying down your principal too. And then if you're house hacking like other tenants are, and then one strategy we didn't talk about is live-in renovation. So if you wanted to hustle even more, you can combine that with this. We've done that twice, and we're about to do that again just now. Believe it or not, every time I say I'm not going to do it again, I do.
Excuse me, I'm sorry to interrupt again.
Yeah, okay.
But you said I don't mean to put words in your mouth, but it seems like you just I hope I understood this right, but you just said the one of the best ways is to basically have a primary home and then like act like you're gonna be there forever, so to speak. And then 2 years later, like you said, act like you're gonna be there, set up the furniture and everything like that. And then 2 years later, you move. Does that have so for the 2 years, right, that you stay there, does that have anything to do with equity? Like is it I don't know if I'm understanding this right or if this has strictly to do with loan qualification, but like if I stay there for 2 years, then if I do it right, if I do the deal right, then for those 2 years I have equity. I should have equity built up in the home. Are those two different things that I'm thinking about?
Yeah, good question. So 2 years is not a restriction. That's just how long I stay there. There's a few different ways to build equity in a home. Okay. So there's natural appreciation, which is the appreciation again is the property going up in value over time. And that means equity, right? The more of a property you own, the more equity you own. Okay. So natural appreciation is the market going up in value over time. You can also force appreciation. That's the renovation or value add option. That's if say you buy like a grandma's house that needs great condition, but like needs new carpet, needs new paint, whatever it is. Those are easy, like it's easy low hanging fruit to add value to the property. So that's forcing the appreciation. And then finally, with each mortgage payment that you make, you're paying down some of the principal balance. So you own more and more of the home, right? And the bank or the lender owes less and less of the home. So you're owning you have more equity and you're owning more of the house in that way too. So there's three different ways that yeah, to your point, like typically the longer you stay in a house, you'll have more equity in the property. So for FHA
Thank you.
financing, yeah, did I answer your question?
Yes, you did. Thank you.
Okay, perfect, no problem.
And then Jessica,
Um,
we have like 10 more minutes. So just
okay,
give you some time. Yeah.
okay, cool. I'm gonna go super quick. Uh, okay. FHA financing, I do feel like we kind of went over this already when we were comparing with conventional. DSCR, I definitely want to go over this. So DSCR loans, debt service coverage ratio loans, basically you're qualifying on the projected rental income of the property itself. We can count short-term rental income for this, which is awesome. As long as the rental income is covering the mortgage, essentially you qualify. There are other guidelines to this, but that's the gist of it. There's gotchas with DSCR loans. Typical gotchas will be if you're a first time investor, the lender's usually going to want more down payment. Okay. If you don't have great credit, they're usually going to want more down payment or they're going to want you to have experience. Typically, no first time home buyers are allowed with DSCR loans. There are exceptions, but again, usually they're going to want more down payment or they're going to want to see you're paying rent elsewhere, a history of that. Usually reserves, meaning like how many months can you make a payment on this mortgage? If it had vacancy are required, usually about 6 months. And then other common gotchas, these DSCR loans are really great for short-term rentals. Short-term rentals are really great in rural areas like mountain towns. It can be tough for DSCR loans. We can do it, no problem. We've financed so many mountain towns, but in rural areas, they do typically want more down payment. If it's a unique property, lenders will want more down payment, such as an A-frame or a dome home. I put this stool here because I like to think of lending as a three-legged stool. Usually you need good credit, good income, and then some sort of down payment or like deposit skin in the game. If you take away one of those, for example, a DSCR loan, like we're not counting your traditional income, they want more down payment or they want better credit. So the credit requirements are higher. So you have to have something for this stool to stand on, right? DSCR loans, we do have interest-only products. That's typically something I'm only presenting to like more seasoned experienced investors, because you're not paying down principal with each mortgage payment. But investors like that because then you're cash flowing more upfront. We do have 40-year terms too with interest-only products, and then like I mentioned previously, they do come with a standard prepayment penalty. So some of the pros, financing is based on your property. We have some folks who have 20 businesses and they just don't want to provide all the documentation for that. So they will just do a DSCR loan super quick, not a ton of paperwork with that. Gift funds are allowed on DSCR loans. So if you're partnering with somebody or if you're receiving gift from family members, you can receive gifts. You can finance and purchase in an LLC. You can count projected short, mid, and long-term rental income. You can receive up to 6% seller concessions or funds or credits from the seller on your purchase. Those can be used towards your closing costs and prepaids or buying down your interest rate, which will help you to cash flow more. Some of the cons, there are prepayment penalties if the loan is paid down or off before that penalty expires. Some limitations for first-time investors and first-time homebuyers. Reserves are required. Usually they have higher down payment requirements. Bank statement loans, these are super common for self-employed borrowers. You can use them for primary home loans, usually 10% down payment required in this current market. The gist of these loans are we're not looking at your tax returns. Most people who own businesses, their CPAs are really good at, reducing their tax liability by, offsetting their income with their expenses. So these we're looking at your 12 months typically history of deposits into your business bank statements or in your personal bank statements, and we're qualifying you on that income, not looking at all at your tax returns. So more flexible option for those self-employed folks or contract workers. Asset-based loans are, if you're high net worth borrowers and you have a lot of assets, say in stock and trust accounts, in retirement accounts, we can actually lend and basically take the funds that you have in those accounts and use it as monthly income. So I have an example here. So say if you had $1 million of eligible assets, okay, you have to back out your down payment from that. We're assuming a 5-year term, even though it's a 30-year mortgage, but this is how much we average your total amount over. So if you take the $1 million, you take out the $150,000 down payment, you divide the net by 60, that would be about $14,000 a month of qualifying income. So those are really good products for somebody else, again, who maybe might not have, income to show, or maybe they're retired, and they don't receive income. They only receive Social Security and it's not enough to qualify. So those are really great creative products too. These potential barriers are going to apply to any of those products in any situation that you're in to get creative. If you were limited on capital up front for down payment or closing costs, super common in the market right now across the country is getting a seller concession where the seller is going to pay to cover your closing costs for you. It is always negotiable. Anything in any deal is always negotiable, but it's really common to see that right now. Sellers can pay to cover your closing costs and prepaids and or pay for your rate buy down. I have that over here again. That's super helpful in lowering your debt to income ratio. If you want to increase your purchasing power, buying down the rate is just low hanging fruit to do so. A lot of people, forget that they can borrow from their retirement accounts. As first-time homebuyers, most accounts allow you to borrow up to $10,000 penalty free, but there's folks who borrow from them whether they're first-time homebuyers or not. A lot of accounts allow you to borrow from your retirement account, and then the interest that you pay is actually, when you pay it back, it's just going back towards yourself. So, and then rates on this are usually lower than like home equity line of credit loans. So I always remind people of that. A lot of folks are receiving gifts from family members, from spouses, from relatives right now for their home purchase for down payment. Super common. Budgeting and saving. I've had some people go drive Uber before and after work, get a side hustle to save. It's one of those things where we all have to make sacrifice, but it's like, I think it's totally worth it. You just make it early on, and then, it's going to serve you for years to come and future generations. Down payment assistance, lots of different products out there. I'm not going to go into it today, but if it's something where you might need down payment assistance, these products are great. There's usually strings attached to it. So we always just want to make sure it's appropriate and you actually need it. If you're investing, capital partners, doing a seller carry, private money lending is another option. And then just putting minimum down. You don't need to put 20% down. I think there's a stigma about mortgage insurance and minimum down payment. Mortgage insurance is not as much as it used to be back in the day. So it's totally fine to put minimum down, even if you have the ability to put more down. I personally think it makes sense to leverage it more and continue to make your money work for you across multiple different avenues, and also diversify your risk in that way. Eric, is this going to cut us off right at 7 p.m.?
No, we can go a little over.
Okay, I'm going as fast as I can. Sorry,
No, we're
guys.
good. No, you're doing great. And I just want to relay a couple things about one, seller concessions. Like most of the deals this year that I've done as being the buyer agent, we've gotten 10 to 15,000 at least in seller concessions. And some of the loans that Jessica talked about there, we had a client together that couldn't qualify for a conventional loan, but he was able to use some of these other loans to qualify and get a home. I think with a conventional loan, he only could get like $350,000 home, but we ended up buying a $650,000 home with some of these strategies and different loan types. So there's a lot of different ways to try to figure it out. And Jessica's great at looking at your options, seeing what's out there, and developing a plan to make it happen.
Yeah, thank you for that. And I was going to say, like, these are like all lenders should have these products available to them, but a lot of them don't use them or don't aren't comfortable with them or it's not familiar with them. So if you're already in conversation with a lender, already in the home buying process, and you're just not getting the answers you want, or you feel like it's not solutions driven, whatever it is, that lender might not like I don't know why for whatever reason like they don't always like think outside of the box with some of these things, so it's okay to still get a second opinion. Because had that client, that Eric just mentioned, never reached out to me, he probably would have never bought a home. And I'm still in contact with him, and he's doing great, and he's house hacking and like crushing it. So I'm so glad he reached out. But some other things, if you're limited with debt to income ratio or purchasing power, student, are you, being in healthcare, I have a lot of clients, who have hundreds of thousands of dollars in student loans. I don't think you should hold that up from investing, but we only have to take a percent of the balance that you have if it's a federal loan, or if you have income driven repayment, we can count the monthly payments for that. A cosigner is a super common option. A lot of relatives, a lot of family members are willing to cosign. When I switched to being self-employed, I got a cosigner. I thought I just wasn't going to buy real estate for 2 years until I could qualify. But no, I didn't let that stop me. I got a cosigner, and then I just refinanced them off when I can qualify on my own. Paying off debt is another great strategy to increase purchasing power. I wrote consult a lender first because paying off debt to improve your credit score is going to be different than the debt you pay off to qualify for more. So always chat with the lender first to see which one's more impactful for your goals. Starting smaller value add. I think we all kind of live in a highlight reel of social media and Instagram, and it's like beautiful homes. And, I'm guilty of that too. But at the same time, like the house I bought, I would not be where I'm at by any means had I not gotten into that smaller house, that I live with roommates in, and it was not cute by any means, but like we added value to it. You know, we hustled, we made some sacrifices, and we started smaller, but I knew that that was going to help me to eventually get to where I wanted to be. So it's okay to start smaller and not get your forever home on that first one, especially if you're in the Denver metro. And, we're in a really strong market here, which means that it can be tough to get your foot in, but don't let that intimidate you.
I apologize. Is it like a crazy idea to do a seller financing deal and like expect um like putting zero down, for example, a seller financing deal of like I put this amount of month down and then I do a balloon payment at the end. Have you heard of deals like that? When you say creative financing, I attune that to seller financing. To me that means the same thing. Maybe I'm wrong, but my overall question is that I've heard, and it seems possible to put zero down and just say like I'm just gonna do these monthly payments. I want my monthly payments to go towards the equity of the house, and then if I miss a payment or whatever I structure the deal, then all the equity I lose all the equity. But if I make each payment and then over, let's say, 2 years, and then at the end of the 2 years, I do a balloon payment, is such things, have you heard of such things actually happening? Or is this like a unicorn thing?
Yeah, so I would say, I mean, I'm not typically handling seller financing on my end, but my investors that have done that, usually from what I've heard, they want more down payment. I think more of what you're describing might be like a rent to own program where you're renting it first, and then a portion of that is going towards the equity, and then if you could eventually buy it, then that's applied towards your down payment. Truthfully, in my experience, those programs are built to benefit the investor, not the renter. Um, Eric, I don't know if you want to add
Yeah,
to that.
I'd say seller financing with 0% down would be really rare. They usually want something at least 10%, usually 20%. Not always, they're out there. I'm not saying it's impossible, but you would have to be doing a lot of outreach to a lot of different owners, to try to find that one owner that would be willing to do something like that. Most will not want to, most are just not going to want to do that. They'll want some sort of down payment.
Um, So some other creative strategies when it comes to increasing debt to income ratio, qualifying rental income, like I mentioned on an accessory dwelling unit or a multifamily, we can count rental income on the other units, or if it's an investment property, we can use projected rental income for those. Lowering homeowners insurance, you can always change it after closing, but just lowering homeowners insurance for the purpose of like getting monthly payment and therefore debt to income ratio lower. Improving credit, we've helped a ton of clients improve credit to qualify for more, because it'll lower their mortgage insurance and lower their interest rate, which then increases their purchasing power. Again, paying down debt can help with improving credit. Forgiveness loans, I'm not going to go into that right now. And credit, the thing is, I think some clients will come to me and they're like, hey, I don't have great credit. Should I wait to buy? Every situation is different. I think, let's have an individual conversation if you're one of those people that you're having that question right now. But with that being said, I think a lot of times it makes sense to still buy, and just we come up with a strategy where it's like, hey, we're getting our foot in the door. And then we're going to plan as like, we're going to get you on a plan to improve credit. And then as credit improves, we're going to be refinanced on the line to lower your interest rate and lower your monthly payment. But I don't think you should necessarily wait years and years and years, let real estate keep going up in value and continue to pay rent while you wait for your score to improve. But all in all, I think starting the conversation sooner and getting individual advice on like how a specific plan for your situation is the best thing you can possibly do. Since we're short on time, I'm not going to go into detail on this today. And then I just want to show a few examples to give you like real life, like how.
Go back and let me look at it really quick.
Yeah, totally.
Okay.
It's basically just a slide high level that shows you how you can use seller concessions. I think a lot of times people think when there's negotiating power with sellers, they think, oh, I'm just going to reduce the purchase price, which is a really great strategy. In this example, again, $500,000 home, assuming closing costs are $7,000. You can reduce the purchase price by $10,000. That's only going to make a difference of $60 in your monthly payment. It's only going to reduce your total investment or upfront cost of down payment by $500. It's going to take you 13 years to break even on that. Instead, I think what's more strategic is offering the same $500,000 purchase price and then negotiating a $10,000 seller credit or seller concession and applying that towards a rate buy down. Okay. Or applying it towards closing costs to reduce your out of pocket, whichever you're trying to move the needle on more. In this example, you would reduce your monthly payment by almost $600 the first year, $600 a month, right? Year 2, you're reducing your monthly payment by $300 a month. And then year 3, ideally you're refinancing before then into a lower rate. But if not, you're back up to that normal monthly payment. This is a really great way. You would literally reduce your monthly payments by $10,000 that first year. You'd break even on this in 2 years versus this takes 13 years to break even. If you're limited on upfront costs to invest in a purchase, like maybe you only have the down payment, the $25,000 saved, and you negotiate a $10,000 concession, you can use that to fully cover the closing costs, which are assumed at $7,000 in this scenario. And then you can use the remaining amount to lower your interest rate for 1 year. So then you're saving $300 a month in monthly payments that first year, which would be about $3,600 roughly in savings. So that's what this scenario kind of breaks out.
Thanks.
Yeah, of course. Didn't mean to brush through. I'm just trying to get through a lot. So this is a really good example. This was the last house that we owned that it was in, for anybody who's in Denver, is in City Park West. Really great area in terms of rental and short-term rentals. So we lived in this house as a primary home. It was a 3-bed, 3-bath when we bought it. There was a separate entrance to one of the bedrooms. So we short-term rented that. We did renovate the entire house while we lived in it, full on hustle mode, and really got into the not uncomfortable part of the comfort profit spectrum. There was no kitchen in this additional bedroom, which I think is key. I think a lot of people think when they're going to rent out a separate part of their house, it has to have a kitchen. We love that it didn't have a kitchen because the cleaning fees were lower and it was a lot less to maintain. We bought this house for $760,000. We got $20,000 in seller concessions, which covered a 2-1 temporary rate buy down. So our permanent note rate was 6.375 to start. And then for a permanent rate, Year one, the rate was reflective of 4.375. Okay, so it reduced our monthly payment from the 5,100 down to 4,200. Year two, it went up a little bit, and then we refinanced by this point. But it would have gone up to this amount year three. Okay. We short-term rented one of the bedrooms that with a separate entrance in the back. I put average monthly short-term rental income as $2,000 a month here. We did a lot higher than that. It actually on average was about $2,500 a month. But just to be conservative here, that reduced our monthly payment to 2,200 year one, which you can't live in a single family home for 2,200 in City Park in Denver of the size, for 2,200, or even 3,100 for that matter. So that was really huge. It wasn't a huge sacrifice, I don't think, because it was a separate entrance, and it helped us pay down our principal too. And we put minimum down on this house. We only put 5% down. Our initial investment was 45,000. We did add value to this house, so we added a bedroom, which added a ton of value. Anytime you can add a bedroom, that's definitely going to add value. Using 5% appreciation alone, this doesn't take into account the value add we did. That property should have gone up to 969,000 by 2027. We got an appraisal of April of 2025. We got two separate appraisals, one for home equity line of credit and one for our refinance. One appraisal came in, it was like 940,000. One came in around like 960, which was crazy. But that's because we added value. We renovated the house, right? So that's
Why
kind of
did you get two different appraisal values? I'm sorry.
because we did one was for a home equity line of credit and one was for a refinance.
Thank you. Sorry. Go ahead.
Yeah, so it's two different appraisers. And then principal paid down in the meantime too. So not even including the rental income that we generated on the property, not factoring in the potential wealth growth. This is just assuming 5% appreciation over 5 years should be about 257,000, right? So that's when I talk about like the life-changing wealth, like that's huge right there. So this combined the strategy of seller concession, rate buy down to cover rate buy down and closing costs, house hacking, and then also nomad approach. We will sell this property most likely. We lived there for 2 years, so we'll probably sell it in the next 2 years because we moved out last year. This was the small little unit that we rented just off the back of the house. And again, no kitchen or kitchenette. When you asked about where do I buy, you have to think about your strategy, right? Do you want to share space with others? Do you want a separate unit? Are you going to short-term rent it? If you're going to short-term rent it, you're probably not buying in Brighton, right? Like there's not a lot of attractions there that people want to go to. West City Park, it's really close to downtown. It's 1 block to City Park. It's right in the middle of the hospital system. So that's something you want to think about, what schools are nearby, what hospitals are nearby, depending on your strategy.
And people will rent that with no kitchen?
Yeah. I mean, it's just like a hotel, right?
Wow. Okay.
It had a mini fridge, it had an espresso machine, it had a Keurig and a microwave.
I also heard that like people don't need a living room and dining room anymore. So
No.
like if I see a house and it doesn't have, let's say, a living room or dining room, that's okay because who uses a dining room nowadays, for
Yeah.
instance?
And if you're
Is that
just
true?
yeah, totally. I mean, this didn't have a living room or dining room. I mean, if you're one person traveling for work or if you're, visiting a friend, like whatever, we have people coming and going, visiting people at the hospital. Like you don't need all that. You're using it as a place to sleep, So, I mean, we had pretty strong occupancy here. But yeah, you don't need a living room, dining room. You don't need, I mean, it's just like a hotel room. Some hotels you get, there's just mini fridge, microwave, coffee machine. There's not a full-on kitchen, right?
Hashtag hostel.
Yeah, exactly. I mean, I think it's a little bit nicer than a hostel.
Well, I didn't mean it like that, but I mean,
No, I know. I'm just messing. This was the first house that I mentioned. We did do the value add approach here too. This was the sweat equity, so we did a lot of the work ourselves. We did hire out some of it. This one we got super lucky. I really think you cannot time the market. We just bought when I thought it made sense. This is my first home. We bought it in January 2019 prior to COVID. We got so lucky with this. We bought it for 445. You could not buy a 4-bedroom house for 445, the same square footage in Centennial. Colorado now. So we added value to it. We sold it in June of 2022, right as the market was changing for 675. This is the house that we were being paid to live in because I live with 3 other roommates who were friends. Remodel and expenses, this is really low because again, we did a lot of the work ourselves. Total with vacancy and everything came out to 41,000. After agent fees, the loan payoff and closing costs, that was 380,000. Our down payment, we did put 20% down on this. I didn't have a lender to stop me and tell me, hey, don't actually put 20% down because your boomer parents are telling you to. So we ended up netting, we took advantage of the 2 out of 5 year rule, and we sold this property in 3 years and netted 172,000. And we got to keep that amount.
What are some
So because
what are some indicators that you use to notify you that the market was changing?
I mean, I was in the industry that I got into
Okay.
the industry at this point, so I had a really close pulse on the market. But I think most people at that time knew, like, hey, interest rates are going up. Um, and that was shifting the demand. So, I mean, like I said, I was in the industry and people, like we saw multiple offers going over asking, and then you saw it start to dwindle after that. Like July, it's crazy, but July of 2022, interest rates crossed 5.5, which at the time was like crazy high. People would kill for 5.5 right now. But it was like crickets. So I think to answer your question, if you weren't in the industry, I'd be staying in touch with, like, I mean, I can give you some resources afterwards. I mean, I can add you to my newsletter and I, share information about market updates. I'm sure Eric has something similar too.
How did you find the deal?
That I actually was working with an agent who was one of my patients. I bought this house when I was in healthcare. Yeah. Yeah, I knew I wanted to house hack. I didn't know it was called house hack. I had never heard that term at the time. But I knew I wanted to have roommates to help me pay for my mortgage because my mortgage payment was really scary at the time.
So it's not
Uh,
what you know, it's who you know. Oh, wait.
yeah, I would say looking back at it, she wasn't like investor friendly. I think if she would have been, I might have bought differently. The first couple of agents and lenders I used, they were not familiar with the strategy that I wanted to do, like the, nomad and rental, like house hack approach. I think especially the second house I bought, had I been working with an agent and a lender too, who were my strategy, like I made good purchases, but it would have been so much better, right? Like they would have advised me a lot better because they had, like it's just like if somebody hasn't done what you've done or if they're not familiar with it, how can they guide you? It's like the blind leading the blind, right? So just to give you a specific, like my second house that I bought, we bought with an HOA, which is fine. But if you're going to rent that property, you don't want an HOA. I don't think. It's just another entity telling you what to do with your business. But the agent at the time wasn't investor friendly, so they were just like, "Hey, I'll sell you this house." So, but really, if you have a good investor friendly, team, yes, your agent should be helping you find a good deal. Okay. So our advice, this is Eric's advice too. Start early. Like I said, I think, it doesn't have to be perfect. It's not going to look super pretty. It's not going to be your beautiful forever home that you're going to share on Instagram and it's going to be so pretty, but like get your foot in the game and just start building equity. Obviously, like I just said, that was a really good transition. Have a really good team on your side who can tell you you're not going to be happy with that long term, or here's why you shouldn't do that. Here's the goals that you told me you had, and this just doesn't align for that reason, or whatever it is. So starting early, getting your foot in the market, with intention, right? Buy with your end goal in mind. If it's going to be a future rental, buy it. It is a future rental. Don't buy it thinking like, I love this house. If you're going to move out in a year from now or 2 years from now, buy it thinking like, this isn't a good school district and I want it to be a long-term rental to, families, or I want this to be a midterm rental. So I'm going to buy near hospitals or whatever it is. If it's a short-term rental, you definitely have to do the due diligence or have an agent who, have Eric help, or who's helping look at the short-term rental regulations. Because the last thing you want to do is buy a house that's with the intention to short-term rent it, and it's not a short-term rental friendly area. Working with trusted professionals, I think, a question that I would ask if I were going out and looking for an agent or a lender right now who's trusted, who I can trust, is like, have you talked somebody out of a deal before? That's going to tell you if they're going to guide you in your best interest. Doing your due diligence on the property, you have a due diligence period once you're under contract, but doing as much due diligence as you can in advance, like checking out the area, looking at the neighbors, looking at the school district, finding out as much as you can about the house, the major systems, the plumbing, the HVAC, the roof, the structure, like a lot of those things you can do before you even go under contract. Asking questions. I always tell my clients, ask as many questions as you can. There's no silly questions. If it doesn't make sense, ask it again. I think my first couple of lenders before I was in the industry, didn't take the time to thoroughly explain or like present options or just show me different options, which is not, I mean, it's not on them. Like I should have, I think, like tried to find a different lender, but that's okay. I think just ask a lot of questions, and you sometimes have to just advocate and just really try to learn so you can feel comfortable with the situation you have and make sure it aligns with your goals. And then again, like your first home is probably not going to be your dream home.
Options as far as what? You said look at
Options.
different options.
Yeah. So like I was saying earlier, like if you don't fit in a box of like conventional, or if
Oh,
somebody,
okay.
like that client that Eric described, that he was pre-approved with the lender for 250,000, that doesn't get you a lot in Denver, right? And he didn't want a condo. So, luckily he knew me from somebody else. So he reached out to me and we got him approved. I think he closed on a house that was like 650, so just providing those different options of like, okay, well, if this loan product doesn't work, let's try this one, or here's an additional, like I never tell a client no. I'm just like, here's a plan. So you have steps and you know how to get to where you want to be.
What's the rate now for a conventional loan?
I would say, I mean, rates have increased. So I would say from where they were, rates right now for a conventional loan with 20% down, great credit, like 780 or above, probably about 6.65 to 6.75. That's without any buy downs. Yeah, you and me both.
Do you do any lending?
I'm a mortgage broker. Yeah. So I
Okay,
help clients finance houses. Yeah.
right. So my question to you is, do you have any clients that's in like billions of dollars of debt um, from, I guess, lending to them for their real estate portfolio or big commercial apartments or, with tons of units? Okay,
Yeah.
okay,
Yeah. Yeah. I mean, and
So
this is, I would recommend, I would listen to, if you haven't already, or read the book Rich Dad Poor Dad. Not all liabilities are true liabilities,
yeah.
right? And that if you haven't, have you read that book?
Yeah, I'm saying like good debt though, because
Yeah, good debt. Yeah.
there's bad debt
Yeah.
and
Yeah.
there's good debt. The good debt
Exactly.
makes
So
you
you
money.
get it. Yeah.
Yeah,
So
yeah,
like I have a lot of debt.
right,
I have a lot of real
That
estate
doesn't
debt.
mean poor. Oh wait, I'm on.
That my like my those I have a lot of real estate debt. Those properties are all cash flowing.
right,
They're all occupied, I mean, there's times they have vacancy, and that's where you keep reserves, right, for rainy day fund, and if there's vacancy or whatever. Um, but I have a lot of debt, but they're cash flowing, appreciating assets,
right.
right? And then,
Mhm.
so I think there's good debt and there's bad debt.
Yeah, I guess I'm just trying to understand um how, like, I guess how much you do as far as like, because I know you're a mortgage broker. I'm just trying to understand like your client base. Like, do you have big clients that do tons of um, properties and, big portfolios, big multifamily with, I don't know, commercial 200 unit type deals,
Yeah,
or do you stick to like people who are just getting single family homes and
gotcha. So we
like
do
that?
residential and commercial. Yeah, so we can lend up to 400 units. It depends. I don't do all commercial though. Like I won't do warehouses, I won't do gas stations, I don't do retail, but we'll do residential, like commercial, like apartment buildings.
Okay.
Does that help?
Yeah, it does. It helped me get an understanding. I know I read your bio at the beginning, but it just kind of skimmed through it.
Yeah, no worries. No worries. Yeah. I mean, you can always reach out. I have no problem telling you if it's something that we don't do. I'll try to put you in the hands
Okay.
of somebody who will. Yeah.
Right.
Yeah.
Thank you.
Yeah. Perfect. Well, this is all I had. You guys asked really good questions. Eric, did you have anything else that you wanted to add?
No. Thank you for bringing all your wisdom and yeah, sharing all that information. That was super helpful, I'm sure, for everyone, and even for me. It's always good to like brush up on some of these things, just to be able to relay it to clients and for myself too in investing.
Yeah, definitely. Well, guys, thanks for listening to me yap for an hour and a half almost. If you have any follow-up questions, either for Eric or for myself, reach out anytime. Like I said, you can always schedule a call. I have my Calendly link here, and then Eric, I don't know if you want to put your information in the group chat for anybody, but reach out anytime if you have any questions. Thank you guys again for attending.
Thank you.
Thank you
Thanks.
all. I'm going to record this, so I'll send you all the recording as well.
Oh,
Have a good
awesome.
evening.
Thank you. I appreciate that.
Yeah, thank you.
Yeah.
Thank you.
Thanks so much. Have a good night.